Welcome to the monthly market update on you and your money, empowering you to reach your goals with tips and insights to help you plan well, invest well, and live well. This month's market update comes from Lawrence Hale, Principal Managing Partner and Chief Investment Officer at Weiss Hale & Zahansky Strategic Wealth Advisors. Take it away, Lawrence.
Give us our usual start to the program, the latest news from the financial markets.
Well, the markets are definitely digesting the fact that the Fed did not raise rates yesterday, and some performance figures through the end of last week, which after yesterday are actually a little bit higher. Definitely some uneven performance in the equity or stock markets, with the S&P 500 posting through the end of Friday up 8.66%. Big difference compared to the Dow Jones Industrial Average down actually 0.5%. And big difference between growth and value. Those are two different investment strategies when you're looking at buying stocks. The Russell 1000 growth up a whopping 21% year to date, whereas value, the winning strategy last year out of the two, actually down 3.66%. And international markets with the MSCI EAFE up about 3%. You know, when you talk with someone about how their portfolio is doing and the fact that, you know, they've had a good year or a bad year or somewhere in between in stock performance, it really, really makes a difference if you're diverse and or what you own, because there has not been even performance. Broadening that out a little bit, bonds down about 2.5%. Despite the higher rate environment through the end of Friday, as the U.S. Bloomberg Aggregate Index. And to give you some perspective on some other rates that the consumers are used to looking at, nationally, a CD rate, 6-month CD rate, is about 2.19% versus a Treasury at a 2-year Treasury over 5%. And those of you that are borrowing money on the individual side, a 30-year fixed rate mortgage, the national average is about 7.9%. And the prime rate, which is a rate that is usually a base rate for a lot of commercial lending and so forth, is all the way up to 8.5%. So we're going to be talking about rates. That gives some people a little perspective on where rates actually sit right now.
Lawrence, with all the spikes in the interest rate there's been in the last year or two, for the Fed to keep the rate unchanged, did that surprise you yesterday?
Not necessarily. You know, we were anticipating at least a pause. There's definitely some question whether or not rates will be raised possibly 2 more times during this rate hiking cycle. A lot of it depends on inflation, which we'll be talking about more. And, you know, how the economy is doing. You know, the dual mandates the Fed has is full employment and keeping inflation under control. And I think they're feeling a little bit more comfortable with where inflation is. You know, it's trending down. And, you know, the economy and particularly employment is actually good. So we're not surprised, but I think their rhetoric, their tone is going to continue to be a bit hawkish, a bit aggressive to make sure that inflation gets under control.
And extending that to the future, the Fed Chair Jerome Powell yesterday hedged on the possible end of a tightening campaign. Do you anticipate going forward that this might be a sign of the future, that we keep things stationary and not more spikes?
I think they can do a lot with just the language that they use and keeping people guessing whether or not they're going to raise rates or not is going to keep people cautious. And you know, part of the rationale with raising rates is the fact that will slow the economy down and tamp inflation pressures. And, you know, they want to make sure they've got a good handle on that. We've been through sort of a wild ride when it comes to inflation and rates and the economy in general over the last 3 to 4 years. And I think the Fed is sort of hell-bent on making sure inflation is tame.
People that aren't borrowing or buying, when they hear this news about the Fed increasing rates or yesterday's news about not increasing the rate, how does that affect the average guy on the street? Is it a big deal for average Joe?
It is. The upward trend definitely is directed anything from fixed income products causing rates to surge across the board. You think banks, if you're an investor or a saver, in particular, they're now offering consumers notably higher interest rates, which is beneficial for those individuals. But that's definitely made it more challenging for borrowers. So those rates, mortgage rates, prime rate, those are difficult for those needing to borrow money, whether they're buying a house, a car, or financing a business.
That's it for today. Thanks for listening to You and Your Money. Find even more episodes, videos, and other resources at our website, whzwealth.com. Be sure to come back next week for more tips to help you live fearlessly and pursue your financial and life goals. Until then, live well. Weiss Hale & Zahansky Strategic Wealth Advisors offers securities and advisory services through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut, 06259, and can be reached at 860-928-2341. Weiss Hale & Zahansky Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals. For more information regarding wealth management and customized financial planning with Weiss Hale & Zahansky Strategic Wealth Advisors, please visit www.whzwealth.com.